you're best off to take up case 11 to grab the spreadsheet that I use in this video. And of course, this link right below here is the video you're watching right now. This spreadsheet you probably want to have open so that you can kind of follow along. I'm going to leave all of the formulas inside of it. And again, if you have not tried this, you should stop this video and go and try it. Right? I give my in-school students a couple of periods to work on this, because if you don't, when you eventually get to the assignment that will be graded, you're not going to have any idea how to do this, right? It's kind of like watching somebody play the guitar. Unless you practice yourself, you're never going to get good at it. So on that note, the first thing you need to do is you need to go and grab the annual report for Lululemon. And the first thing you look at when you grab an annual report is not the PR and all of the glossy pages of pictures and how amazing they're doing. You go and you look at the auditor's report and you find this sentence. Right? In our opinion, the consolidated financial statements present fairly, notice there's no word accurately, present fairly in all material significant respects, yada, yada, yada. Excellent. We can use these statements now. Let's move on. So we're going to scroll down to starting with the balance sheet. And in our books, in our file, in our assignment file, we had this to do. We had this information to find. And I'm not going to do it for you. And I'm not going to do the ratios for you either, except the new ones, because we've already been through this in a couple of videos, a couple of lessons and a couple of take-up videos. So you should know this by now. And if you don't, go back. This is what we've covered, right? We've done these sort of intro lessons and these cases with these take-ups, and there are links here. And they're also linked on the syllabus with the sort of ready, rusty background. So if you can't remember, review it. But here they are on the screen, and they're in this file that you can go along as well if you can't get these numbers. The practice file, though, sort of marked it as you did it. But if you can't figure it out, here are what the numbers that you should have got going through it the first time. And the new values, or what you actually really had to do that was different, was calculate some things by looking at the notes. But before we get to those, let's talk about the actual financial ratios. So you couldn't do accounts receivable turnover because you couldn't find credit sales, and for the most part, there are no credit sales for a retailer. People who come in pay for their stuff in cash, and that's it. So there is no credit sales. So in this case, the operating cycle is merely going to be the length of the inventory turnover. Right? Usually it's the sum of these two, but there is no accounts receivable turnover. And again, we can only do it for 1 year because we can't calculate average inventory for 2016 because we don't have the value for 2015. I mean, you could go get it. It's not that hard. You would go to an earlier annual report. So let's do this. This is inventory turnover is new. It should actually be this color because that's the color of our new stuff. So let's just do it from scratch one time. So what we're going to do is we're going to take 365 days and we're going to divide it by our turnover number. And the way we find that turnover number is by finding cost of goods sold divided by average inventory, right? And our cost of goods sold is going to be on our income statement, just up here. Here it is. Remember, it's the dollar value. Cost of goods sold, $12.50. And this is a negative value, so we don't want a negative value as our turnover. So we're going to put a negative sign in that to, two negatives makes a positive. So there's a cost of goods sold. We're going to divide it by our average inventory. We can actually just use this average formula to go up here and grab this year's and last year's ending inventory value. And that should give us about 92 days, which is actually pretty good. But we'll do the analysis sort of down this column in a second. The last thing we had to do was earnings per share. And if you go to the annual report and you go down here, you'll notice usually in the equity section, it'll tell you how many shares are outstanding. At the end of the income statement, it tells you what the earnings per share is. And the basic earnings per share is what you're looking for. And it also is going to tell you the basic average number of shares that were outstanding during the year. And again, it's an average because that kind of thing, just like accounts receivable or inventory, it changes during the year. So this is the average number of shares that were outstanding. And remember, this is in thousands. And if you couldn't figure out what was going on at first, I made these in millions of US dollars or millions of shares because different firms make the reports using different sort of ratios, different quantities, right? Different proportions. So you got to get used to being able to convert. So you had to turn these numbers that were in thousands into these numbers, which were in millions. So the number of shares, the average basic number of shares outstanding was about 136 million, right? And that's right here. You had to round. So if you round the first decimal place, it would round to a 0, and this would become 136. And that's why we got 136. And the earnings per share then is going to be profit, so net income, right here in the current year, divided by the average number of shares outstanding in that year. And you got about $1.90 of profit per share in 2017 and $2.21 for 2016. It fell. So those are essentially the new ratios, the new financial statistics that you need to know how to do. But once you've got them, you need to do some analysis. The first and most obvious thing when we've done these common size stats is that cash and cash equivalents is literally half of all asset value, which is enormous. That's a huge amount. In fact, it's probably too much. Except Lululemon is a recently new, it's like a recently new business, and it's still expanding, and it doesn't borrow to expand. It actually uses its profits, its cash, to expand and open new stores. So this makes sense in this particular context. As you can see, the receivables, nobody goes into Lululemon and buys on account, so there's almost no receivables. It's like not an issue, not even what we're talking about. This is not too bad, and it's actually falling. And that means they're able to operate their turnover. We don't know what it is because we can't remember down here. We can't calculate turnover for the previous year. But if we did, I bet it's improved because our inventory value is falling in terms of how much it takes up of our total assets. That's good news for as long as you have such little inventory that customers can't find what they're looking for. That's a problem. But this is generally good for solvency, and so is falling prepaids. Because remember, prepaid expenses are things you pay for in advance, so your cash is gone. Here, no necessarily real issue, except you can see that property, not from the ratio, but from the dollar value, you can see that assets are growing, which means that they're probably still expanding stores. And if you go to the note for long-term assets, which is note 4, right? That's your long-term assets. You will be able to see that. And so we're going to go to note 4 right now because there's some issues here with long-term assets for these retailers. Lululemon has a little index for its notes right before the notes start, right after the financial statements. And this is in the PDF file. It's on page 48. And it tells you note 4 is property and equipment. It tells you it's on page 56. So let's go to page 56 for a sec. Here we are, note 4. And you can see that Lululemon does own land. It owns buildings. And it owns something called leasehold improvements. And that's things that it does to the spaces that it rents in shopping malls and stuff like that. So if it adds ventilation and shelving and stuff like that, sort of permanent fixtures, those are leasehold improvements. In addition to the furniture and fixtures that they stuff in there, right? And what's important with this is the fact that most of this value, there's two things that are important that you should spot. One is this is almost half, maybe 40%. Of total asset value. And this is accumulated depreciation, right? Or accumulated amortization. That means half of their assets they've decided have no future benefit. Almost half, 40%, whatever that is, right? And something else you should know about retailers. When you go in and you sign a contract to rent store premises, and you make these leasehold improvements and you add this shelving and the fixtures that are in there and the lighting and you make it look great, there's very little value to any of those assets when you no longer rent that space, like when you leave. I mean, sure, some of them you can take somewhere else, but by then they might look dated. They might be old and ratty. They don't fit other spaces. So there's essentially no real long-term value to some of these things. Land, building, sure, but leasehold improvements will be worthless when you leave. So there isn't a lot of depth, I guess is the word, to these assets and their longevity and what you can use them for in terms of maybe leveraging them to borrow money to expand. So you have to be aware of that. With a retailer, and Lululemon, it's no different. If you recall, this could be the reason that Lulu is expanding with cash as opposed to debt. I mean, it does have some long-term debt, but not very much. And this is why I have this point here, that this asset value here, this total almost $500 million of asset value is a little bit less misleading. Some of it doesn't have much long-term use. So moving on then, current liabilities are really quite steady. So that's good news, especially because up here you tend to have improving liquidity with constant short-term debt in your current liabilities. That's pretty good. But the real thing with retailers in particular is this one. Long-term debt is low, right? It's only about 5% of total asset value. And in fact, we scroll down to our ratio for debt, right? Our debt ratio is only about 20% in 2017. That's nice and low, right? So they really are expanding with their cash flow and not their debt. But retailers or firms that rent space have something that's just like debt but isn't, and therefore it doesn't appear here. And you need to go to Note 16 to figure this out. So let's take a look at Note 16 for a second. Note 16 is the second of the two sort of things in notes that you're expected to kind of look at in grade 11. One is sort of asset value, a little bit more depth to asset value, and this, commitments and contingencies. And they can be things like lawsuits that a company's about to lose and have to owe lots of money, or other types of contractual commitments they are stuck to that are going to have some kind of financial impact or impact on the business that would result in someone's opinion about the business and whether to invest in it or lend it money would be impacted by the knowledge of these commitments. And you could skim this if you want to, but really just do what it says and go to the table on the top of the next page. Take a look at this. Here are the operating leases, which means rent, basically, that they owe for all of their stores. Look at the dollar value of this rent that they have to pay in each of these years for the existing contracts that they have signed. They don't own all of these stores that they have in malls and stuff. They rent them. And because they didn't borrow anything from these landlords, from these shopping malls, so they don't show anything on the liability section of their balance sheet. But it doesn't mean they're not going to have to make these payments every year. And these payments are just like mortgage payments. They're big. You have to use cash to pay them, and you can't get out of them. It's a contract. So it's just like debt, except that you didn't borrow anything to begin with, so it doesn't show up on the balance sheet. So these types of contingencies, right? Contingent liabilities are sometimes called off-balance sheet financing. It's really important for certain types of businesses, and retailers are one of them because they often have lots of premises and stores that they rent. So this is almost $612 million of contractual obligations in the next few years that they have. So let's go back to the balance sheet and add that in and see what happens. Long-term liabilities are currently about $109 million. So if we had to add back in $612 million, we'll call it, that would change a lot of things. So let's just put this in. Let's add $612 million to this number. And remember the accounting equation, assets equals liabilities plus equity. If we're upping liabilities and we don't have any more assets to show for this, then our equity has to be going down, right? So to make this balance, we're going to up that by 612 and subtract this from ending equity. And let's take a look at what this does to our ratios. Our debt ratio just went up to 36% from 20. It almost doubled our debt ratio as a percentage of total assets. That's huge. So in total, we have the right total now. It's 51%. Went from, 20 to 51%. Because when we add that rent, right before, it was 20.1. That's a huge difference. So if there's no way you'll come to the same conclusions if you forget about contingent liabilities for companies that have lots of contractual obligations, but that haven't borrowed that money. So in other words, like retailers that have stores they rent. So you have to consider that. And you actually should leave that value in when you start to assess risk from debt and exposure and payments and solvency issues. All right. So once you've done that, you were asked to figure this out, consider that information before you formed a final opinion on Lululemon, and then try to come up with what would be a reasonable value for this company in comparison with Nike. And then decide which one do you think you would pick. So let's do this. This is the truly new stuff. So I have done this I've started to save us some time. So this was given, if we say going rate of interest and a reasonable investment is 5%, this came straight from the income statement. And remember, don't go to a place like Yahoo Finance. I mean, you can, but we're going to take a break for like 30 seconds to show you why. This number, net income of $258 million, came from Lulu's annual report, right here, $258 million approximately was its profit. And you'll notice in well, in 2017, the fiscal year ends after the holiday season, right? So it's in 2018, but this is the fiscal year of 2017. So it ends, and in this year, they have something they don't normally have. They have this gross profit going along. They have operating expenses, essentially what these are. And they have this one-time sort of charge to operating expenses for restructuring, and then they have their income from operations. They have a couple other random things. And then here's their income that they always show before tax because you don't have any control over tax. And you end up with this net income. And you'll see that this one-time charge was only in the fiscal year for 2017. Take a look at Yahoo Finance. Take a look at this. You see anything? Non-recurring costs. Look at that. 38,525. What was it in the annual report? 38,525. Wait a minute. They have it in every single year. That's wrong. It was only in the year 2017. This happens all the time. This is why they have a disclaimer up here. They have disclaimers. They have warnings. They say, don't actually use this. We don't make any guarantees about it. There are mistakes. So if you want to be absolutely sure, you need to go right to the source and look at the annual report. I mean, there are advantages to this, right? Because you can sort of, at the very left, you can grab this, go to the very last digit, and copy and paste it right into a spreadsheet so you don't have to type it all out. But make sure your eyeballs are checking the annual report that the numbers match. That's the key. So back to our valuation then. If we look at the net income, you'll see it's 258. So that's where I got this from. And if you recall the formula, and as it tells you the formula, well, see case 6. We already did this. The return on equity method of coming up with a rough value is is essentially you take the net income and you divide it by the rate of return, and it gives you this value here. So if we look at Nike and you grab Nike's annual report and you look at the same places, this is their net income. And if this is the required rate of return, how much would you have to invest at 5% to make this profit? Or for Lululemon to make this profit? Well, these are the numbers. So this is about 5.2 billion. And remember, this is American money. And this would be about 85 billion. So clearly Nike is a more valuable company, but it's also a larger company. So that isn't necessarily going to say, it sort of gives you a rough idea for value, but not necessarily how much you would pay to invest yourself unless you knew how much of the company you were buying. The other method is market capitalization. Now, market capitalization is going to be different depending on when you go to look for the stock price of a share of Lululemon or Nike. So on the day I went, the stock price of Lululemon, the closing stock price, was $106 and change, 41 cents. And for Nike, it was $72.81. And what you have to understand is that, and we went through this in the intro lesson, that you can't say that this is a cheaper company just because its stock price is lower. What you have to decide, that issue is sort of, the PE ratio helps you resolve that sort of concern, because you still could be overpaying for one versus the other. You don't know. But based on what the market is saying, what you do is you take the number of shares issued, and that is something Yahoo Finance is useful for. If you go here, instead of under financials, like your income statement, your balance sheet, and cash flow, annual or quarterly, whatever you're looking at, make sure you know you're looking at the right one for profit and stuff like that. But if this statistics button has a whole bunch of sort of financial or stock related information. So it tells you the market capitalization here. It gives you a calculation. If you use that, you're in trouble, because I want you to calculate with the numbers that you have in an assignment. And if you use this, you're not going to know, you're getting the wrong mark. You're not going to get the right value. So what I want you to look for is the shares that are issued and outstanding. And that is 125.9 million shares. That's what you would use this Yahoo Finance for, really, is current information like this. You can use it, and I will probably specify in anything I would mark, whether you use something like this on the financials, down here where we did earnings per share, right? Where you look at the annual report and you see that the earnings per share, or the average shares outstanding. So whether it's average shares outstanding, which we get from the annual report down here, right? The basic average number of shares outstanding during the accounting period, during the year. Or whether I want you to use something more current, like what you would get from Yahoo Finance for the current shares that are outstanding. That would probably be clear in an assignment. And if not, you can ask if it matters which one you use. So in this case, I use current for both Nike and Lululemon. That was the stock price when I looked. And you multiply the two together to get the value, the market capitalization, or the market value of the company's equity at the moment that I checked for these stock prices. So the market thinks that Nike is worth about $92 billion. And oddly enough, that's kind of close to our return on equity method. But this one's way off for Lululemon. The market is giving a much larger premium to Lululemon. So this last bit, I haven't talked about this yet, is if you took this money, this much money, and got this much interest paid to you, what would that be? As a percent. So this, quite simply, is this divided by this, times 100 if you want, or use the percent formatting method. It's about 5%. Well, it's exactly 5%. And that's, of course, because we picked this number up here. Right? Because we took this profit and divided it by 5%. So when we take 5%, so when we take this and divide it by this, you're going to get the same number. It's just mathematical certainty. You can mull that over if you like. It's not that important. But this is what this profit is 5% of this price, of this value. Market capitalization. The profit they're making, which is also this amount, or you can also take the earnings per share and divide it by what you're going to pay for a share, right? Because that's sort of why companies give you the earnings per share. So if you took this earnings per share, $1.90 we decided, right? If you look back here, $1.90. So in 2017, $1.90 divided by the stock price, or the profit of the company divided by the total market value, which is the same thing. The only difference is earnings per share divided by a stock price is doing it on a per share basis. This is earnings per share. This is total earnings. So if you take total earnings divided by total value, or you take earnings per share divided by the value of one share, you're doing the same thing. And the rate of return is only about 1.8%. For Nike, it's substantially higher. And the reason is a mystery until you get good at this sort of stuff and are more knowledgeable about the company. The fact is that investors have bid up the price of Lululemon. You're going to see that when we do the last valuation method. And the reason they've bid it up, well, I'll talk about it when we get to the last one. So the last one, we again took the current market prices when I looked, and we then took our earnings per share, which we got from the balance sheet, from our earnings per share calculation, that ratio. And we could even use this one here, right? Current shares for Nike was this, and their net income was this. I got it from their financial statement. You could also just get it from Yahoo Finance if you want to estimate quick. And that gave it earnings per share about $3.30. So when we take the earnings per share and we divide it by the current, it's the other way around. When we take the price, right, it's PE ratio, so price to earnings. So we take the price and we divide it by the earnings, we get these numbers, which are quite remarkable. So this price divided by this earnings gives a multiple, it's called, that's another word for it, gives a multiple of almost 56, which means you're paying $56. When you buy a share, you're paying $56 for every dollar of profit per share that Lulu's earning. Whereas you're paying less than half for Nike. Notice that because this is a per share base. You're doing the same thing, market capitalization. This equivalent interest is the same calculation because you're doing the same thing. It seems different, but it's actually the same calculation. You're figuring how much, if you paid 106, how much is this as profit when you pay this for a share? So what's this return per share if you pay this for a share? So it's the same thing as what's your return if you're paying this for a share and this is your profit, what's your return? It's the same number because it's the same calculation, right? So what matters here is sort of how reasonable is the pricing of this company. And 56 times as a multiple, paying $56 for a dollar of profit is pretty high when Nike is this and Google is this and Facebook is this. So and it's not necessarily wrong. It's just perhaps expensive. So if you decide that Lululemon is a terrific company and you want to buy it, this might say, well, let's just not buy it yet because it's too expensive. And there's also times when even though it's super, super expensive, it still might be a great buy. Because if the market is giving this premium, right? This is a premium. Look at their return on this price. It's much lower than Nike's. Right? And here, this multiple is huge. A 56 PE ratio. Why would investors be doing that? I mean, some investors might be naive and not know what's going on, but all of them? The reason the market or investors would be buying shares at this multiple is because they believe Lulu is going to grow a lot. They must think that Nike is already saturated the market, can't grow that much more. But Lululemon has miles of road to run, right? It's a newer company. They could still build lots more stores to compete with other retailers. And of course, more stores means more revenue, which means more profit. Early on in these analysis lessons and activities, I told you the primary driver of value is profit. And if investors think that profits are going to grow, then the company is going to be valuable. Much more so. One of the most critical things is accelerating revenue growth, which of course always comes from growth and expansion. So in that case, the multiple could be justified. That's how you do the three types of valuation that you expect to sort of have a grasp of. So let's go back and quickly just look at some of the things that you should have spotted below liabilities where we ended off. So down here, we've got revenue. And if you look, revenue growth is actually increasing. You can't really tell from just 1 year, but if you look back, you do have accelerating revenue growth, which is part of that 56 multiple that Lululemon has for its PE ratio. This, when we talk about margins, right? Remember your financial analysis. We've done this. We started with this, already finished. Right now, we're looking for flags. Revenue growth can't really do because we only have 2 years, but I've told you that I did look back and they do have accelerating revenue growth. The next thing you look at is your margins, and the margins are good. The key margins with a retailer to look at first is the cost of goods sold and gross profit margin. And as you can see, the profit margin is actually going up. And it's because the cost of the merchandise, the stuff they're selling in their stores, is falling. That is really good. That's the main thing that you have to control as a retailer, and it's improving. The only reason that their profitability down here actually went down, that's the next margin you want to look at, is essentially they did have this one-time charge, but it's a one-time charge. It won't happen again. You don't have to worry about it. Really? It's done and over with. The real reason this went down is because of taxes. It's almost this one-time charge and taxes explains the decline in profitability, and you can't control taxes. So essentially, if the number you really want to look at, as it says here, is this. This is your operating income before the government gets involved, which you can't control. And it has actually only gone down 0.6, right? Your profit margin went up by more than that. The only reason you're down in the final bottom line is largely because of taxes and this one-time charge. So Lulu did have a lower profitability year, but it's actually not that bad if you look into the numbers. Most of it is a one-time charge and the rest of it is taxes over which Lulu has no control. Otherwise, they're operating at improved efficiency with their main margin, their gross profit, improving. The last thing we want to look at are some of these ratios. We mentioned them. We didn't really talk about it a lot, but the inventory turnover is about 90 days, which is a quarter of a year, which is a season. So for a clothing company, turning over your inventory once a season is the bare minimum, and they're meeting it, so it's good because you don't want winter clothes when summer comes around. So 90 days is kind of the limit, and they're at that. Debt, we already talked about this. This looks good, but it's really not that good. It's almost, we're starting in a bit of a danger zone with the expenses, right? The debt ratio. And it's not really debt, but you have to be aware that there is a large liability issue. You'd want to, contingent liability issue, right? With the rent. So you'd want to make sure that the rent leases that they sign grow only sort of on pace with revenue. So, I mean, if they want to double their stores, you're going to end up doubling your rent. And that's okay, provided you double your revenue. That sort of idea. And that's essentially it. So from that, you would have to decide whether this is worth the money. Would you pay? So is this company and its performance, which looks generally pretty good. And of course, again, we haven't looked at one of the most important things, which is the revenue growth, which is the reason it has such a high PE ratio. We haven't really looked at it, but if you did a full analysis, you'd look at all these things and you'd probably come to a conclusion that it's a pretty good company in a pretty good situation with growth ahead of it. The only question would be, is the value it's being given worth the price? And of course, you wouldn't buy this to earn dividend income or other types of income you can get from stocks. You would buy this for growth in the value of the stock price because the company's growing so rapidly. But it's already priced in that growth, right? That's what this multiple means. They're already giving it a high stock price because they expect it to grow, which can be risky because if that growth doesn't materialize, you watch this stock crash. That already happened actually just a couple of years ago. So you'd have to decide, do you want to go for safety and earn a fairly decent return? You should know that any company with a multiple 20 plus is expected to be growing, and Nike is growing. That's a tough choice. Only you can make it, but you can't just analyze a company because accounting and then make the decision, because accounting numbers are the past. And when you invest, it's about the future. And you have to consider what the growth trajectory in the future is probably going to be based on what they've done, and simultaneously looking at the price you would have to pay and whether it's too rich and too valuable or whether it's cheap and affordable and it's a good buy. That's how you use valuation in combination with using financial analysis and financial statements.